There are moments in the financial world when several global events collide at the same time, creating confusion, volatility, and unexpected reactions across stocks and crypto. Today's XRP analysis focuses on exactly that moment. A series of regulatory decisions, macroeconomic surprises, and institutional comments created a ripple effect across the entire digital asset market, and XRP was no exception. To understand why XRP moved the way it did, why the market became unstable for a few hours, and what new institutional developments might influence XRP's position going forward, we need to break down everything that unfolded. Hey guys, welcome back to Whiteboard Crypto Update. In today's video, we will talk about XRP. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads. Please remember this is not a financial advice video. The starting point was a widely discussed report highlighting an unexpected drop in ADP private payrolls for November. Instead of the anticipated rise of around 10,000 jobs, the number unexpectedly fell by 32,000. Sudden employment weakness always pushes the Federal Reserve into the spotlight because lower employment often creates pressure for more interest rate cuts. This macro surprise gave traders the impression that monetary easing could return sooner than expected, and for a brief moment the markets reacted sharply. Some assume this shock was the reason behind the sudden volatility in crypto, including the quick dip and rebound in XRP. But a second event quickly took the spotlight, this time from the regulatory side. The U.S. Securities and Exchange Commission issued new warning letters targeting extremely leveraged ETFs, particularly those offering 3 to 5 times leverage. The regulator expressed concern about funds that aim to deliver more than 200% leveraged exposure, arguing that such products amplify market instability. The timing of this announcement created immediate waves in both the stock market and the crypto market. As soon as the crackdown news dropped, price behavior across assets became erratic. XRP followed the same pattern seen in Bitcoin and Ethereum, a quick downward move followed by a sharp bounce, a pullback, and then a return toward its earlier price zone. XRP briefly slipped, then climbed, then oscillated, until it settled again near the same level where it started the session. The broader behavior was similar across major cryptocurrencies, with Bitcoin showing a roughly 2% rise, Ethereum around 5%, and XRP sitting modestly higher by about 1.5% around the 218 area. The trading day essentially turned into a sequence of fast reversals, one moment down, the next moment up, reflecting how sensitive the market currently is to regulatory headlines and macroeconomic uncertainty. There was also attention on the latest ISM services data. The numbers were slightly above expectations, but still close to the projected range. That meant no major surprise from the services sector. However, the absence of a clear directional push from the economy allowed the leveraged ETF crackdown to remain the dominant narrative driving volatility. Another perspective came from analysts noting that most retail investors do not fully understand the nature of leveraged ETFs. These instruments are meant for extremely short-term trading because they rebalance daily. This daily resetting causes something known as volatility decay, meaning price swings can erode the value of these products over time. When markets fluctuate sharply, these ETFs can lose value faster than many realize. Since such funds have been popular for years, but their mechanics remain misunderstood, even subtle regulatory changes around them can shock the market. And when both stocks and crypto react simultaneously, the pressure naturally spreads to assets like XRP. Adding more complexity was a separate global development, Japan's financial situation. The yield on Japan's 30-year government bond surged to a record 3.43% after reports indicated that the Bank of Japan is considering raising interest rates. For decades, Japan maintained extremely low or even negative rates, enabling the famous Japan carry trade, where investors borrow cheaply in yen to invest elsewhere. Now, despite recently approving a large stimulus package worth about $135 billion, Japan is still discussing possible rate hikes. The combination of printing stimulus money while also preparing to raise rates is unusual, and many analysts view it as another sign of deeper global financial imbalance. When major economies begin to shift monetary policy unexpectedly, global markets, including crypto, tend to react nervously. All of this means that even when the crypto market shows strength on a particular day, there are still several global macro factors capable of disrupting momentum. Market conditions remain sensitive, so price reactions may appear sudden or inconsistent. Anyone following XRP must keep in mind that short-term movements often reflect broader financial turbulence rather than XRP-specific fundamentals. Turning back to the crypto space itself, digital asset funds recorded a strong resurgence. Recent data shows that crypto investment products pulled in roughly $1.1 billion in inflows over the previous week, the largest amount in nearly 2 months. This reversed a prior stretch of 4 weekly outflows totaling about $4.7 billion. The United States led the positive momentum with almost $1 billion flowing into crypto funds. Canada and Switzerland also saw inflows, while Germany experienced some outflows. Bitcoin attracted the majority of the new capital with around $461 million, followed by Ethereum. In contrast, short Bitcoin funds saw nearly $1.9 billion in outflows, suggesting reducing bearish sentiment. This is important because institutional flows into Bitcoin and Ethereum often influence the broader crypto environment. As market confidence rises, interest tends to spill over into other large assets such as XRP, especially now with XRP ETF products entering the market. These emerging financial products give investors new avenues to access XRP exposure through regulated investment channels. An additional highlight came from major traditional players discussing crypto adoption. A global asset manager managing trillions in capital commented that the growing national debt in the United States could accelerate crypto adoption. The reasoning is that as government debt expands, alternative stores of value and decentralized assets become more appealing to institutional investors seeking diversification. Around the same time, another leading financial institution with more than $11 trillion under management confirmed plans to enable Bitcoin and Ethereum trading for its clients in 2026. Millions of traditional brokerage clients will soon have easier access to crypto, representing a massive shift from the era when institutional platforms restricted or discouraged crypto involvement. With major firms now offering crypto ETFs, crypto trading options, and long-term infrastructure, the traditional financial system is transitioning from resisting digital assets to integrating them. This environment has significant implications for XRP, especially after comments from Ripple CEO. During a recent panel discussion, he highlighted how rapidly XRP ETF inflows began. In the span of just 2 to 3 weeks, more than $700 million moved into XRP ETF products, an impressive amount considering that these ETFs were not available in the United States until regulatory clarity improved. He emphasized that crypto currently represents only about 1–2% of the entire ETF market. And based on the rapid institutional engagement across multiple assets, many believe the percentage is likely to rise. One striking example mentioned in discussions was the trading activity of a major Bitcoin ETF operated by a leading asset manager. In a recent session, this crypto ETF reportedly recorded more trading activity than one of the most iconic stock market ETFs in the world, the S&P 500 fund operated by a major brokerage. This comparison illustrates how quickly interest in digital assets is expanding among large investors. A crawl, walk, run pattern is forming. Institutions that once waited on the sidelines due to regulatory concern are now beginning to participate. For XRP, this shift means increased visibility, increased accessibility, and eventual integration into a broader financial ecosystem that is becoming more open to crypto exposure. As ETF infrastructure strengthens, the presence of XRP in regulated investment products will continue to connect traditional capital with the crypto world. Well, guys, that's all we have for you today. What are your thoughts on XRP? Get involved and let us know in the comments down below. If you guys like this video, then be sure to give this video a big thumbs up. Thank you for watching, and we will see you again in the next video. Goodbye.